Good afternoon, everybody, and welcome to our webinar. My name is Marc Ashton, and I'd like to welcome you on a chilly day in Joburg. Firstly, thank you very much for making yourselves available and giving up some time in your afternoon to join us today. Just some general admin around these. For those who are not familiar with the Zoom functionality, you're welcome to submit questions via the Q&A facility or via the chat facility on the right-hand side. The intent is always to make these things as interactive as possible. I think there is plenty of Zoom and team fatigue as it stands at the moment. So the ability to ask questions and interact with each other, I think, is going to be a critical part of this session. If for any reason you do get disconnected, there will be a playback facility made available of this audio, and you'll be able to submit any follow-up questions. As I say, I think a big part of this is about relationships. I think we've had a lot of this lockdown culture has been exhausting. We've forgotten how to interact with a lot of our kind of professional colleagues, industry peers, etc. And the intent would be to give, to be able to build ongoing professional relationships. So we look forward to engaging not just over the webinar, but over the next couple of months and seeing if there are ways that we can assist and develop some solutions in conjunction with you and your teams. By way of background, my name is Marc Ashton. I was the former editor of FinWeek magazine for 3 years. I ran MoneyWeb for 3 years, where it was delisted in 2017. I've always had a passion for kind of the stock market, entrepreneurship, venture capital, and the whole world of finance to me is something that has always been a world that's been very exciting. And since leaving MoneyWeb, it's been an opportunity for me to engage with a number of industry peers around things like capital raising, corporate advisory work, DTI incentives, and ultimately it's been, we host these webinars with the intent of sharing some knowledge and kind of contributing to general industry standards and industry body assessments so that we're able to go and build a general sense of knowledge for the industry. My guest today is going to be Guy Addison, and maybe just Guy, before we kick off, maybe just give us a little bit of background. Who are you? What do you do? And what is your kind of claim to fame?
Good afternoon, Mark. Thanks for having me, and hi to all the Zoomers out there. So I am a finance and accounting professional by background, qualified as a CA in the early 2000s, and have worked in corporates as well as small businesses, largely in the M&A corporate finance field. So I come with a transaction background, and of late, in the last 5 to 10 years, have really got quite involved in the corporate governance field, and specifically where the intersection of governance and, you could say, finance intersect, which is in remuneration. It has elements of both technical and financial and accounting aspects, so it really tickles a lot of my fancies and interests. I run my own firm, Addison Advisory, and am merging my firm at the moment, which will soon be called Addison Comline. That's a little bit about me. And excellent. I work in Stanton. Yeah.
I mean, Guy, I think one of the things that's really been interesting, I mean, we've kind of followed the stock market and we've looked at kind of what's happened to listed equities and it's been a pretty miserable time in general. I mean, I remember in the good old days where shares used to go up. But I mean, I think one of the things that we've often wanted to talk about was, and it's one of the things that you've maintained, a lot of these share-based schemes share-based payment schemes are no longer fit for purpose. They're not going to set out the objectives that have been set by their teams and the organizations concerned. And ultimately, you've got a combination of poor equity performance, high interest rates, lackluster economic growth. It's all kind of weighing on these pre-existing remuneration schemes. It's quite a broad statement to say that they're no longer fit for purpose, but maybe give us some sense of what is a share-based payment and, where do you see the industry going?
Okay, so to start with what a share-based payment is, essentially it's using your company's equity to procure goods and services as opposed to paying for those goods and services by using cash. So you effectively put it on your balance sheet, for want of a better description. And so you bypass the income statement in terms of a share-based payment. That's on a very simple basis. Where it's important for remuneration is oftentimes a company will use its shares to remunerate its employees as a way of trying to align their interests with the interests of the shareholder body.
So, I mean, that sounds, in theory, that sounds great. I mean, here it is. You're effectively conserving cash. You're able to use a tool to attract the talent, to remunerate the talent. But, what is the problem with these existing structures as you see them? I mean, what are the downsides to these structures?
Well, generally, there's no such thing as a free lunch. So in these circumstances, whilst you may think that you're not necessarily putting it through your income statement, accountants require that you recognize some form of cost in your income statement. And so as part of IFRS and IFRS 2, you are required in order to recognize the cost of that instrument in the income statement. But most importantly is that existing shareholders are ultimately the ultimate payers of these share-based payments. So whilst you're using your balance sheet, it looks easy, but in fact, your ordinary shareholders are effectively being diluted, which means that you use the reserves of that organization to make these payments. That's one of the key issues.
So, I mean, we understand, this initial issue that the shareholders face, but I mean, why should these executive payments be phased in like this?
Well, it goes back largely to your comments initially that markets are no longer just steadily increasing. There isn't that nice gradual increase in the share price. And what's happening is that executives' performance and the share price for which, and the company on which the share price is based, are being delinked. So the share price performance doesn't follow the executive performance. And if you think about recently, many executives will have worked harder today than they've worked ever before, but you'll see in many companies their share price hasn't reflected such. But linking that executive remuneration just to positive movements in the stock price is focusing that executive's mind on actions that are expected to only result in an increase in the share price in that relatively short period of time. And that's where the disconnect or some of the issues that are being felt is that you're necessarily focusing an executive's mind and attention just on improving the share price. And as we know, markets generally don't follow a perfect line, and it's very hard to try and manipulate that share price, but that's effectively what the game is pushing for.
So, I mean, why are companies then cancelling these share-based payment structures? I mean, in your view, I mean, obviously we've got the extraneous circumstances, the likes of COVID-19, market volatility. I mean, in March you were down 30%, in May you're up 50%. I mean, it's been incredibly volatile market. It's incredibly difficult to kind of define how you're going to manage these share-based payment schemes. I mean, why are organizations cancelling them?
It's a good question, Mark, because many of these structures have liabilities on the other side of the structure. So what happens is that executives gear or borrow against these positions with financial institutions, and thereby they increase their expected gain from a relatively modest number of shares awarded. So what this means is that you effectively have a derivative in place with a financial institution, and where you've got this massive volatility, sometimes the obligations on the other side of the transaction require that there's some kind of exit. And you will have seen that in examples like Mediclinic and EOH, where there were derivative positions that were closed out when the collateral of the share that was issued no longer covered the loans taken. And what we've seen then is basically downward pressure on the share price because you have a tranche of shares that is forcibly sold in order to cover a position. And we've seen others like RCL and Break cancelling their structures because the input details at which such structures were being set are so different to the current factors in the economy.
So, I mean, this kind of leads to quite a contentious question, but I won't disclose which of the small micro lenders it was. But many years back, there was a micro lender that was based in Dunkeld, with a head office in Dunkeld, and it was high flying. And I remember going and asking the CEO at the time, why they spent so much time kind of gearing up on their share positions. There were CFDs, there were single stock futures, etc. And he was adamant that the company couldn't pay him enough for the work that he was doing, and so this was his way of supplementing the income. But I mean, surely executives have enough money anyway to live off their basic pay. I mean, is that not kind of the core of this problem? Is that actually the expectations or the base pay are no longer being used as kind of the core remuneration for many of these executives?
It's a good question. It's more complex than that, but essentially, if you look at these structures, they are effectively trying to align the incentives of management with the shareholders. So they're being categorized as long-term in nature and really trying to get the executive to perform for the rest of the business beyond just the basic remuneration that they're almost getting as a guarantee. But what my concern is that oftentimes leads to executives taking inappropriate decisions to drive the share price up or down in order to take advantage of such movements.
But I mean, yeah, a lot of time it's like, who cares? I know that, you know, you'll have one or two journalists who kind of dig into the annual reports, look at the remuneration. But, you know, there is a bit of a so what factor to these remuneration. Often it's quite clicky. It's very much looked after in terms of what's said in the boardroom stays in the boardroom. But, you know, who actually cares about this? I mean, why does it matter to anybody?
I think it's the unintended consequences of these structures that everyone should be aware of, Mark, especially company boards and those responsible for the remuneration policies. You know, companies are largely responsible for the savings of most ordinary people in the form of our pensions and life investments. And if there are questions around value being destroyed at these listed companies, it means ultimately our society suffers. You know, the poorest citizens of our country rely heavily on corporations to pay taxes, to provide services, and ultimately to provide employment. And if these structures that are being put in place that are ultimately guiding the most important decision makers in these companies are wrong in the beginning, ultimately there's nothing stopping these companies from losing their way.
Before I move on to kind of this next section of the presentation, I maybe like to throw it out to the audience and give them a chance to respond here. I mean, what are your kind of views around share-based payments? I mean, do you largely echo Guy's views from this perspective? I mean, feel free to pop it into either as a comment or anonymous question via the Q&A facility. But I would be interested to get your sense of, you know, where you see share-based payments going, you know, whether you think that Guy's thinking is aligned from this perspective, or is it just a case that we're experiencing some negative markets at the moment, and so therefore executives are looking for alternative ways to kind of bolster or justify their remuneration at the moment. So I'm going to give a couple of minutes just to get an answer and see if there's any thoughts that you'd like to pop into the Q&A before I move on to the next section. It looks like we have no dissenting voices at the moment. So, Guy, I think you're largely on the right track here. I'll keep monitoring the Q&A facility and the comments section as well. But maybe also give us some sense of what else has changed in the world of executive remuneration. What are the things that you need to think about from from the remuneration perspective?
Certainly, I'd be remiss of me not to mention the tax effects, Mark. I think there's been a lot of changes in tax really in the last 10 to 15 years, but as recently as 2016, we've seen changes in the Tax Act, principally related to what are called restricted share structures. But yeah, the tax man's certainly keeping us on our toes. And if you look at what really the SARS have focused on and the government have focused on, taxing executives has been a key priority. I mean, if you look at capital gains tax in the early 2000s, and now effectively share instruments being all taxed according to one's marginal tax rate. And that has been expanded the definition of what is considered a restriction as recently as 2016. It's made remuneration far less efficient. And as a result, there's a lot of changes that are really required in some of the structures that have been in place in some companies that I've looked at for the last 10 years. They're just not fit for purpose anymore. I'm not saying that tax should necessarily be driving those changes, but they're certainly not, they haven't considered the changes in the tax structure.
So before I move on here, I mean, it's interesting that our Q&A section has definitely come alive here, and there are a couple of interesting things. And I'd really like to try and move away from presenting at people and rather getting some of the feedback around this. I mean, maybe just kicking off with this question here. I mean, are you suggesting that using equity as an incentive is no longer a viable option? Okay.
No, not at all. I think equity is still going to maintain a very strong place as far as aligning the interests of executive management and the ordinary shareholders are concerned. I think it is one of the key ways that you can get executives to consider how they will be improving the valuation ascribed to an entity, and that their actions will be consistent with looking after shareholders who aren't traditionally part of management and making decisions in that business. But I think there's a distinction between using some of the old structures, which tend to be not working. And as a result, it's created a perverse incentive where you find executives are going back to their boards and asking for greater and greater basic pay. And what that means is that effectively executives are getting away with a guaranteed package as opposed to doing anything that's improving the valuation of the enterprise. And so SARs are not going to necessarily be kicking up a fuss because they are generally enjoying a 45% return on that type of increase but it's generally ordinary shareholders and principally those that are charged with investing the savings of people that should be concerned about this, because if they're ultimately losing more and more because these structures are not fit for purpose, there's a lot of questions that should be asked.
This is something, a question from Martin that's come through here. And I mean, I think it's a question that you and I were debating off here a little bit, is relating to, the suitability related to kind of these geared structures. So, I mean, I know as a financial journalist with the journalist hat on, I mean, it was always fun to kind of trawl through the SENS announcements and see who's putting CFDs on and who's putting single stock futures onto the market, etc. And I mean, the reality is that we've just seen people get burnt, and the reality is they get squeezed out on these positions for sellers. I mean, Blue Label was a very good example not so long ago. But I mean, the question comes in, he says, I agree that the highly geared structures are often not advisable, but I'm interested in Guy's view of other share structures, such as the restricted shares or performance shares that are much less geared and can be more aligned and more in line of sight performance metrics. Thoughts?
Yeah, it's a good question. I've found that in using these structures, there's really little difference between a share appreciation right, what's called a SARS in the market, and bonus awards, or the many myriad of names that are given to these structures are ultimately really just derivatives of the growth in the share price. Yes, there are mechanisms to leverage them or gear them, which enhance the returns to the participant and potentially place the company's ordinary shares at risk. But ultimately, what we're talking about is one kind of share structure. It really is a bet on growing the share price from whatever it is trading when the instrument is issued to what it's trading at when the instrument is unrestricted. What my view, and we'll get there, is that those structures are really the same thing. Whatever you call them, the tax man, as far as SARs are concerned, treat them in exactly the same way as far as the growth in that share price whilst the instrument is restricted is subject to one's marginal tax rate. And we know that executives are probably at the top marginal tax rate, which is currently 45%. But what we're seeing as a result, and the perverse incentive I get back to, is that because these things are not paying out and they're not making enough money for these executives because the structures are not the right ones in the first place, you're having more and more emphasis being placed on basic remuneration. And that basic or guaranteed remuneration is not actually driving the right behavior.
It's a question here that's come from Jacobus, and it's not directly tied to this, but I know it's one of the topics that we've kind of discussed a little bit before, is remuneration in an unlisted environment. And I obviously don't want to get, to move too far off topic here. But, there are we've had a couple of discussions around remuneration in an unlisted environment. I mean, do you expect there to be some alignment between or changes in that space as well that you can kind of foresee coming in the next couple of years, particularly with these kind of high growth startups, a lot of the Section 12J companies attracting startup, delivering investment for a number of these tech companies? I mean, is that an area that you can see a remuneration is going to come under more scrutiny?
I think certainly under more scrutiny, both by company boards. They're going to look at trying to use structures that may have been the reserve of listed companies of before. But I think particularly in SARS's context, a lot of executives I talk to are not aware of their structures from a taxation and a corporate governance perspective until such time as SARS comes and reviews the structure when they'd like to actually pay it out. And the executive have oftentimes not considered that they are required to withhold the tax prior to paying over the benefit to the employee. They have to withhold the tax like they would do PAYE in the case of ordinary remuneration for an executive. And that oftentimes catches up companies, and I imagine with smaller companies is going to be a concern of theirs, is they haven't actually had someone look at their structure and consider it from a tax perspective. They've just kind of gone along with what they thought was the right answer. I've found with my experience that very few people get a proper understanding of remuneration structures in their education at university or in the early years of their career. So it's really worth in my view, trying to find people that have actually seen these in the market and understand them.
Excellent, thanks, Guy. I mean, I appreciate that. And I say, I'll pop you a couple of links as well separately to some of the stuff that we've done previously, some of the discussions that we've got. Maybe one of the things quickly, and into the comment just from Craig down on the right hand side, talking about the cap in the UK in terms of increased guaranteed pay. Firstly, guys, I really appreciate you taking the time to put the questions into the Q&A and trying to be as interactive as possible. It makes a world of difference to the presenters to be able to actually field real-world questions. It's one thing to stand up in front of people and present thoughts, but the fact that you guys are taking the opportunity to engage makes a huge difference to us from a presentation perspective. Guy, maybe just coming back to kind of the topic that we've been discussing, these incentives they've got a strike price. We end up in a situation where the share price is now underwater per se, and all we see is the executives going back to the remuneration committee and saying, well, that didn't work out so well, we want to rethink this, we want to kind of have the shares issued again, or new remuneration policies put in place. I mean, what is the kind of, what is your step when you look at an organization and you see that actually this remuneration policy that you came up with a year ago is now completely underwater?
I think a lot of executives are going to do exactly that, Mark, and I think it's going to create a lot of uncomfortable questions, not only of the industry, but also by institutional and sophisticated investors, your life companies and asset managers, of saying, look, you've gone and spent enough time to develop this remuneration structure, and you're telling us now that it doesn't work, that you're just going to reset the fundamental input details into the structure and make us believe that this now is going to align your interests just because the share price has moved. And I think it really exposes the problem that you've got here, is that it's not aligning the interests of shareholders with those that are making decisions on behalf of their companies. What's happened really in a lot of these circumstances, because of that high tax rate, and I'm speaking principally about South Africa, is that these executives never actually hold the shares that they are awarded. They simply sell those shares in order to settle the cash, the obligation for tax, and they pocket the difference and ultimately take that difference and use those cash resources elsewhere. Now, I'm not saying you should restrict them to what they should be allowed to do with their own earnings. But what it's doing is it's not allowing executives to actually hold shares in the company that they're working at. And so we're moving away from that whole alignment argument, which is we want our executives to be shareholders in this business because we believe that's the right thing for them as executives to think about existing shareholders.
So I mean, you have the populist and pitchfork brigade. I mean, they kind of pull into Moneywave, they pull into Fin24, and they quickly point out that South African executives are ripping the ring out of it. There's a huge disconnect between the the entry level staff and the executive staff. I mean, is it fair to say or generalize or characterize South African executives as only being interested in their remuneration and how much they can take out of the system?
I don't think it's fair. I personally think that executives in South Africa are exactly the same as executives in the UK and Australia and the United States and other advanced economies. I believe that they've seen how to play the remuneration game, and this is how the industry works globally. We are no different in South Africa to what's happening globally. Yes, we're probably a bit slower to adopt some of the best practice examples that are happening in the advanced economies, but what executives have worked out is that with the benchmarking process, the way that remuneration is generally described, if you as a senior executive and have a certain position and profile in a company, you can rely on a benchmarking process to ensure that you achieve a suitable level of remuneration, which doesn't necessarily mean that your interests are aligned with the organization for which you work. Now, is that because people are gaming the system? That remains to be seen. Is it because that's necessarily just what anyone would do in that position? I think I would favor that approach, is that anyone in that role would necessarily do that. The point is it's up to boards and those charged with the governance of those organizations to necessarily ensure that there's alignment of interests. The executives are doing what's in their best interests. It's the remuneration committees and, broadly speaking, the boards of these companies that should be implementing the right remuneration and skills in the company to ensure that value is created for all stakeholders.
So one thing, I mean, it's always struck me, and I mean, I related the story yesterday, I think, to you about going to one of the listed companies' AGMs, one of these virtual
Yes.
AGMs the other day,
Yeah.
and I was the first shareholder they had ever had that didn't sit on the board or wasn't part of their exco. I was their first shareholder they had had since they listed on the JSE to attend their AGM. There was simply no kind of check and balance in terms of where there's a retail investor participation, where there's institutional investor participation. I was quite literally the first shareholder. I mean, they treated me very cordially. They asked, did I have any questions that I wanted to ask about it, anything I wanted to share, and it just struck me as there's very little kind of. It's almost perceived that the boardroom is there. The decisions are taken by a group of people, and these decisions are there to kind of reward themselves. And I mean, yes, I think business is very clicky. A lot of these companies are vertically and horizontally integrated. We're all very personality driven in terms of South African listed businesses. But I mean, this thing's been going on for years, surely. It's the same remuneration consultants, it's the same non-execs, it's the same kind of core shareholders. There's almost no check and balance in place. I mean, do you think it's actually going to change? And is it changing and maybe we just don't see it?
Yes, I think there's a question in there. I'm just trying to think about it. I think there are changes happening, Mark, and there's a lot of positive things that are going to be coming, let's call it from offshore or from beyond our borders, that just by virtue of our interconnectedness, the fact that we do have a well-regarded exchange and regulatory environment for large and listed companies, you'll start to see some of the trends being picked up. And I think what that means is that those that are ultimately responsible for making the decisions need to be aware that that the status quo is not going to remain forever. There are some changes that I think are going to have far-reaching impacts, and it's part of my my role is to be able to bring some of these trends to light and be able to share those with the listeners and with our market, because I believe that the companies that are ultimately going to embrace these trends are going to be the better performing companies than those that are still trying the old tested structures that are not working, in my view.
So I think this segues into this follow-up question that comes from one of the via the Q&A facility here. I mean, what sort of share awards does Guy think are preferable if share awards of some nature are still appropriate?
I think they are still appropriate, so let's get that through. But in terms of the right kind of share awards, I think the move is towards a more trusting, open and transparent approach. So what we're saying is that we're not trying to forecast the future by trying to predict exactly how a executive is going to get paid based on a benchmark-based remuneration. What tends to happen is we start with the answer and then we work backwards towards getting what the number of shares that need to be awarded in order to get to that number. And without getting too complicated, I don't think that's the right way to be settling shares. What we need to be doing is allowing executives to act and behave like grown-ups. And what I mean by that is we should be unrestricting share instruments. What we should be saying is an executive should have the right and the privilege to be able to subscribe for equity within an institution that they work for, without some of what are called golden handcuffs or restraints, or some of the ways in which remuneration structures have been put in place to what we call retain those executives. What we need to be looking at is unrestricted instruments, which effectively treat an executive like a grown-up. And that executive will then become a shareholder like all the rest of the shareholders within that corporate.
I suppose this is a follow-up question is, what do you have when you have a dominant shareholder is also kind of an executive remuneration, is also an executive, that you've almost got somebody who's playing both referee and kind of player as well, and third umpire, if you'd like to take the sports analogy on. I mean, they effectively, you could look at African Bank, where we've got somebody who has a dominant personality, a sizable shareholding, and is able to drive through a lot of these original, drive through a lot of decisions based on their kind of strength of personality. I mean, what do you do in a situation like that? But maybe that also then kind of talks to this kind of next phase of the presentation relating to corporate governance. I mean, what are the trends that are happening there?
I think it's ultimately the reason that corporate governance has risen as such an important and crucial part of organizational theory and management. In the last 20 years, we've seen a drive to establish corporate governance principles and best practice, things like the King Codes, the Cadbury reports in the UK, which has ultimately been to distinguish what is necessarily good for one shareholder versus the remaining stakeholders within an organization. And we're seeing it more and more today, is that an organization, be it a corporate entity or be it a non-profit, has far more stakeholders involved, and those stakeholders need to be considered, they need to be recognized, and there needs to be a concerted view on how they necessarily participate in the business. And what's happening at some organizations has, there's a lot still to be done. And I'm not saying that they've got it right, but I think one of the key places to start is to follow where the money is. If you look at where the money is going and you look at what's happening with remuneration, I believe that is a key place to start, and how that remuneration is being used to drive the decisions and actions of the top decision-making body within a corporate. If you think about executives and you think about their remuneration, their basic pay traditionally has been a small proportion of the overall package. Their remuneration has generally been weighted towards long-term and share-based remuneration. And I believe that's still the right principle, but how it's been currently undertaken is just wrong, in my opinion.
Question that comes in then is how would you retain your executives if the shares are unrestricted? I mean, there's again, we have a culture of personality business operators in South Africa. We believe that we should be paying top dollar and often overpaying because of a certain level of a certain level of perceived skill. But I mean, how would you kind of retain these executives if they're working on unrestricted?
I think that, I mean, the argument is in my mind flawed, because ultimately you're trusting someone to necessarily put the resources and actions of multi-billion rand organizations, but you're not prepared to trust them to act in the best interest of that organization when it comes to managing their wealth. So I don't think those two arguments are necessarily congruent. I understand the risk of treating an executive as if they could walk away, but if you're prepared to pay them, let's say, a 30 or 40 million rand basic pay package, but you're not prepared to unrestrict the instrument by which they can necessarily become a long-term shareholder in the business. And I think ultimately there's something wrong with our system. It's not necessarily that you need these checks and balances to make someone behave properly. I think trust has been lost in a lot of organizations. And I think trust in the senior executive to behave accordingly is one of the key places to start. So I'm not saying there aren't risks for executives and companies alike with unrestricted instruments, but I think it's a good place to start in terms of with that trust question. Do you trust the executive that's running the organization? If not, you probably shouldn't be putting them in the top office anyway.
And things like these clawback provisions, I mean, you think that they're worthwhile? I mean, does it make a difference? Is it is it sufficient stick and carrot? Or I mean, what's your kind of view from where these clawback provisions that are built into a lot of these contracts now?
Okay, just to explain to listeners, and they probably understand clawback provisions, but ultimately that's a mechanism by which in a remuneration contract, you can necessarily go back to an executive and say, we've paid you incorrectly. We'd like to now claw back a certain proportion of that remuneration because you've either acted unethically or we've realized the numbers that you presented to us as your results were not really the result. I think there's still a place for it. And I think any remuneration committee should be considering clawback provisions. But if I think about the size and scale of many of these executives' remuneration, that scale of remuneration means that ultimately the executive is going to use that money that they've been paid to try and fight that in court. So it's not going to solve the problem. Clawback provision is not going to solve. And I think if you look at Marcus Jooste, that's a good example. It's certainly something that's necessary, but not sufficient in these examples, in this situation.
I think we're going to see the money back from Marcus Jooste and Steinhoff. I mean, I think this is kind of one of these. I mean, we do have the situation where, I mean, VBS is obviously kind of topic of the day, but everyone is pointing at Steinhoff, and I think it's from a corporate governance perspective, from an exchange perspective, from an auditing perspective. I mean, there's no question that Steinhoff was the black eye that the industry didn't need. And I can remember when I started out in financial journalism, I mean, Marcus Jooste and the Steinhoff guys were very aggressive in terms of geared share positions. They made themselves a significant amount of money, and now they've got almost a war chest in which to kind of fight the fact that they either it's going to keep them out of jail or at least keep them out of the, out of the eyes of the regulators, because they've got enough money to push back to a lot of these corporates.
Yes, I think that's part of the problem. And unfortunately, one of the key things that the governance industry hasn't necessarily addressed appropriately is some of the ways that enormous fortunes have been made in the recent past are continued. That loophole or that door remains open, and those structures remain in use today at many listed companies.
But then do you think, these clawbacks, does it actually make any sense to have them in the system? Or is it just a nice to have, and you're at the end of the day not actually going to be able to action them, and there's a smarter way to do it?
I think it's part of the solution. I don't think it's the entire solution. I think there's things like minimum shareholding requirements that are going to become a more and more prevalent thing in corporates, whereby executives have to hold a level of equity and they can't necessarily go and cover that exposure. And what that's going to result in is executives sitting in the same chair as ordinary shareholders and feeling the pain when those shares are necessarily crashing. I think that's one of the ways that executives are going to start thinking like shareholders. And I can see also the binding vote that many companies are implementing on executive pay and remuneration structures coming to South Africa. I'm not sure if you're aware, but we have what's called an advisory vote in South Africa, meaning really that, if shareholders don't like the remuneration structure, they can just give it a sort of a thumbs down, but it doesn't really have any teeth. And as a result, remuneration committees and consultants don't really take it seriously enough. But what we're seeing in the developed economies is those are binding votes. And essentially, if you don't get it right, then boards are going to change. And I think that's going to sharpen people's minds and start to really bring in some innovation and some ideas to the table rather than the same old, same old.
Yeah, I think that's a very fair comment. You often read the AGM votes, and the remuneration structures don't really, or the proposed remuneration doesn't kind of pass muster, and the shareholders vote against it. And effectively, the answer is, okay, we'll hold a conference call, and you can kind of tell us all your problems, or you can pop us an email. But actually, your vote doesn't really have much of a sense of. It doesn't carry much weight, and I think it is quite disappointing to be able to look at people and say, actually, I want my vote to count. And I think that's still one of these big issues in terms of shareholder activism in South Africa, is that we just don't have the shareholders who are prepared to actually stand up and fight for kind of what was right and what they believe is the best management of the investment.
And I think with the challenges that COVID's bringing, Mark, and some of the real structural and post-COVID opening challenges that our companies are going to face, you're going to find that sophisticated investors, which really are the sharp end of the wedge of change in this country, are going to start questioning the remuneration structures that they've voted on in the past. So I'm hoping that a breath of fresh air is going to be invigorated their decision making, and that they are really the right place to be able to understand these structures and push for some kind of reform and positive change here in this respect.
It comes across that you're almost saying the remuneration system in South Africa is broken. There's not a lot of positive that we can work around. Maybe just a sense. Is the system broken? Is it due for a reset, or is it just going to be business as usual? We can make the right noises, but it's just going to be business as usual going forward.
I think it takes time. I think many of these structures have been in place since pre-global financial crisis times, Mark. So there's a lot riding on these structures. Many people believe that because they're not broken, and because people are saying, that they're patently wrong, there's no reason to change them. If it's not broken, why fix it type of argument. And I think there's also a vested interest in maintaining the status quo. There's a huge level of influence in terms of determining the board composition and remuneration structures that executives have oftentimes waited their entire lives to be part of. So I can understand that this thing is not going to change overnight, but I think it starts with people being able to say, look, there are other ideas at the table. And I'm not saying that executives are overpaid. I'm actually saying the opposite. What I'm saying is that there's generally not an alignment. People are happy if you're growing value for your ordinary shareholders, but they don't like it when it's heads I win, tails you lose type of approach. So in my view, remuneration structures that are currently being used are broken, but I think there's a lot of light at the end of the tunnel. Hopefully it's not an oncoming train.
So you been quoted a couple of times in the media, and these share appreciation rights things are becoming quite prominent. I mean, what are your thoughts on these as instruments?
I don't think they work, Mark. My view is, and based on analysis, those structures are necessarily reset numerous times. And what it's leading to is actually executives losing a lot of hope that their long-term incentives are the way to necessarily generate true value for themselves and their companies. And what is happening as a result is they're going back to their companies and asking for greater and greater basic pay. And I have no problem with them earning more, but I just don't think it's actually right. If you're saying these are long-term incentives, you're convincing shareholders to necessarily go along and vote on these things, when in fact you're just paying the executive more because these structures are not working. So in my view, they should scrap them. And I realize many of them have been around for many years. And so it's going to take a while for them to come up for reset. But I believe that post-COVID, there's going to be an argument for let's look at these things and let's understand really what it's doing to derive the performance of this company.
And then this brings you to this kind of question about duration and tenure on boards. I mean, we've in some cases you've got a lot of these kind of older family-owned businesses where Sasfin being a very good example, where it's kind of a multi-generational institution. It's got a number of people. The family has been involved and stay involved throughout throughout its listed duration. But I mean, you are starting to see, a lot of hopping guys, guys failing to meet their remuneration, failing to meet their kind of targets that have been set for them by the board. And so their duration is and tenure is significantly shorter. What does that do in terms of decision making when it comes to remuneration planning? I mean, how do you kind of plan for something when you're not sure whether the executive just appointed is actually going to be there next year, or it's going to take take the next best offer that comes along to them?
I think it's one of the big problems with the key issue that's been called the retention issue is how do you retain executives? I believe that the right kind of executives have their value systems in line with serving the interest of their shareholders. That if you're looking at an executive that's just going to jump ship for a better offer, that ultimately you're not necessarily going to be driving value for your shareholders. But that doesn't do away with the fact that executives are serving shorter and shorter durations at companies. I think we've got a generational issue as well with the baby boomers starting to take a step back and allowing the younger generations coming through. But there's certainly a lot of pressure and responsibility that goes along with managing these multi-billion rand enterprises. And it's incredibly tough. And executives expect to earn enough within a relatively short period of time without assuming that they will be able to stay at the helm for so long. In the old days, you had executives serving tenures of 10, 15, sometimes 20 years at the helm. These days, that is the exception, not the rule. The rule is that executives work so hard in a very defined period, in a short defined period of time. And they expect to do well enough that if they can't find another job straight away or another role straight away, that they can necessarily survive and do well out of that position whilst they hold it. So I think these are some of the contributing factors that need to be taken into account by the industry and by boards. Boards need to recognize someone's can't be there for 10 years before they need to necessarily start seeing their share options and share appreciation rights or bonus shares actually vesting.
And I think this almost ties into the comment that Craig's made here, in that the moment you start to get a sense that your remuneration package, your share appreciation rights are underwater, you're incentivized to take more risk to kind of make up the difference. You want to kind of knock it out the park so that you can get your remuneration back on track. And it ends up almost promoting that culture of risk taking. And yes, we always want our executives to have some degree of appetite for risk. But, we almost see this culture of trying to hit it out the park. I mean, your thoughts there? I mean, do you think that there's a way to kind of marry up between the appreciation rights and the risk-taking element from a remuneration perspective?
I think for me, firstly, the best remuneration structure is not going to turn a bad executive good. And likewise, a terrible remuneration structure is not going to make a good executive bad. But I acknowledge that there are some executives that do take unnecessary risks, and they necessarily put the company and the lives of all the stakeholders at risk by necessarily trying to comply or meet the terms that have been structured in their long-term incentive. And that's one of the failings of the governance industry, and it's one of the failings in corporates, which is not necessarily placing corporates in a good light in our current economy. There's a lot still to be done here, Mark, and I think whilst I'd love to say remuneration can solve all those problems, it's not necessarily going to solve everything, and ultimately comes down to making sure you've got the right people on the team.
I'm cognizant of time, so and I think that one of the things that we often see when we kind of do these presentations is there's almost this, not disconnect per se, but there is some disconnect in you have the theory and the real world experiences. I mean, maybe just run us through what kind of, if you look at your clients, I mean, what are they experiencing, and what are their real world challenges versus the theoretical challenges that we all know exist?
I'm noticing a lot of disillusionment by management, Mark. There's really a disconnect between what the board has been implemented and what they've been told is best practice. And then when it comes time to looking at their so-called paychecks or trying to reflect the numbers correctly in the financial statements, they're really saying, but hang on, one, I've got to recognize a huge level of cost because of this IFRS 2 issue, but two, I'm not seeing the actual number in my bank balance. And that's leading to executives feeling very disillusioned. Shareholders believe that they've got the right kind of alignment, and there's not necessarily anything wrong with that executive. They're doing a great job and they're performing well. It's just that the structures are not necessarily paying out. So there is turmoil, I think, in all levels at companies. Boardrooms are very reluctant to change. As you said, there's a very close-knit community of executives out there that tend to manage most of the executive remuneration landscape in the country. But no one is really happy. And I think they don't really know who to ask about it. There isn't a lot of, let's say, leadership in this respect, and no one's really challenging the status quo.
All right. I mean, I think that's a fair summary of where we're at. I think that there's obviously going to be a lot of it's going to depend on what comes out from, we look at all this quantitative easing, or what do they call it, loose monetary policy, or stimulus in the US, and I think we're going to see the same thing happening in the local market as well, because this is going to be a very hot topic for the foreseeable future. How are we going to kind of align what happens on the stock market versus what happens in the real economy? And I think this is a major issue that's still going to be very topical. But we've got a couple of minutes left. I'd like to maybe just throw out to the audience, I mean, if you've got any questions in general around remuneration that you'd like to maybe bounce around for 5 or 6 minutes before we wrap up here. There's a question here about BEE share structuring and share incentives. I mean, do you think that this is separate to the existing remuneration, or is it, when you look at your executive remuneration considerations and you've got triple BEE considerations in terms of, share packages there? I mean, do you see that this being part of the same package, or is there better, smarter ways of structuring these BEE deals where they're aligned with management, Guy?
It's a great question. I think it's potentially open for a whole another webinar, Mark. But just broadly, some views on BE. I think it's part and parcel of ultimately trying to achieve an objective using the equity within your enterprise. And one of the objectives around transformation in our country is to get executives into the previously white male domain of boardrooms and get them to actively participate in the management and governance of these organizations. So in that respect, I think there's a huge opportunity for BEE type of structures to be far more active and proactive in terms of driving the right kind of behavior within the organizations. I think it's time for another stakeholder within our economy to necessarily shape the questions around how we remunerate and align incentives for executives. Beyond the technical side, though, or rather the principal side, the technical side for me probably is far too complex to try and work out how to achieve both BE credentials and remuneration of your executives. Ultimately, what we're saying is that executives, be they black, white, male, female, need to be aligned adequately and in line with growing value for all stakeholders within the organization. And I believe then, as a result, the principles of BE and effective and responsible remuneration are aligned and consistent. Hope that is enough of a
Yeah,
a
I think
response.
I think it's a very broad question. And I think
Yeah,
that the reality is that there there are two elements. I mean, there's both
yeah,
a scorecard element, but there's also a remuneration element. And I think that they kind of, while they may work hand in hand, they probably two sides of a similar coin. So I think we need to have that in mind. Question here: any incentive schemes that are currently preferred that are not related to equity shares? So, for instance, profit share or other incentives. Is there a move away from equity to other forms that you're aware of?
there's certainly another domain which is really just making it's call it an artificial type of link based on the performance of the company, and that would be something like a royalty based on revenue or some kind of profit share on a measure such as EBITDA. Now those are gaining in popularity where executives are not prepared to suffer the risk of being part of a restricted share structure, and ultimately the tax of both structures, be they artificial or restricted share structures, are exactly the same. They're both taxed according to your marginal tax rate. So I think whilst people are saying, look, I don't want to be involved in the equity, there are long-term benefits for being an equity participant in these companies, in that you are really part of the decision-making platform. If you only are looking at the cash and the returns that your company is necessarily paying you to achieve a certain level of performance, you lose the ability to direct and govern the institution, even if it's from a very small shareholding perspective. I think what you're trying to get here from your executives is executives that think, act, and behave as if they were shareholders at the same time. You just can't do that with an artificial incentive structure.
I think that's fair. I mean, and maybe this next question ties into kind of your Quibus's question from earlier. I'm just going to kind of paraphrase it here, but effectively, they heard your discussion on Classic FM, where you were talking about the slicing pie methodology and the kind of valuing or how you kind of value equity contributions in early stage startups. And while I say I don't want to get too into it because it's a little bit off topic here, maybe just quickly run people through kind of the slicing pie methodology and give them a kind of 60-second understanding of the work you're doing there.
Certainly, it's really appropriate where the company is not at a profitable phase, and therefore its equity is being is really not worth anything up front because the business is not making any money. Now that's a very different dichotomy to, say, a listed business which is making a level of returns that can justify a certain share price. But what we're looking at the other side of a business life cycle is our startups that really have either a fixed or a dynamic type of view on the equity. A fixed mentality would be, I start the business, I get 90%, and you join me and I give you 10% of the business. Or a dynamic where it changes based on the inputs that go into that business until it reaches break even. So effectively that equity can then adjust based on how much you and I would necessarily invest in the business. And that investment can be in the form of time, can be in the form of cash, or can be in the form of any other resource. And that's where dynamic equity is actually, or slicing pie as they call it in the US, is such a great way of starting businesses. Not necessarily a great way of remunerating executives in listed companies, but it's a nice tool, and I'd certainly suggest anyone that's interested in it to look at slicingpie.com.
Excellent, thanks, Guy. I am cognizant of time. It doesn't look like we have any other questions that have come through here, so I'd like to maybe wrap up. I mean, maybe Guy, a couple of closing comments from your side, and then how do people get in contact with you?
Certainly. Please reach out to me on LinkedIn. You can find me on Twitter at Guy Addison. You've probably seen a couple of my posts about today's webinar, or else email me at info@addisonComline.co.za. It's ADDISON, Comline, COMLINE.co.za. I'm also happy to get back to anyone and we can have a telecon or answer any questions you may have. I think, Mark, you've promised me one more webinar on share-based incentives, and I'd love to be able to just tell people a little bit about that, if I may,
Yeah,
with
absolutely.
the time that we've got available. What we're really going back to is basics here in terms of remuneration, and I think there's a call for it, and there's an overwhelming body of evidence that trusting executives with shares that are unrestricted is the way forward. It's not a perfect structure, and there is no such thing as a perfect structure, I can promise you that. But I maintain that it does substantially align the interests of management with shareholders. And I think what our webinar is going to be about is really explaining some of the pros, some of the concerns, and some of the opportunities to really change the face of remuneration in large corporates.
Excellent, Guy. I appreciate your time. And firstly, and sorry, lastly, I'd like to just say thank you to the webinar participants. As I say, it's really refreshing to be able to engage with you and be able to ask questions and feel like we're contributing to a general, to a topic that seems to be becoming increasingly more uh, in vogue and topical, and it's been great to just interact with you all and share some of these questions and answers. We'd really love to carry on this discussion offline as well and be able to take these discussions further with you. So please reach out. Please make this a more than a once-off meeting. We want to keep this as an ongoing interaction. And thank you very much for your time. And say we will circulate a link to the playback facility. And we appreciate your participation. Thank you.
Thank you, Mark. Appreciate it.